Imagine waking up tomorrow and discovering the stock market has plunged 30% overnight. What happens to your savings? Your business? Your plan? Could it really happen? And if so, when? Right now, valuations are high. Debt levels are rising. Are we heading into another crash or just a correction? What history can teach us and what signs you should look out for? I know what you're thinking. You are thinking that I've heard this before. The market always comes back. That's true, but the path back isn't always smooth. So today we'll walk through 3 major crash scenarios from history. The warning signs they shared and what to watch for today. Stay with me until the end because I'll share 2 concrete signals you can track yourself. Let's begin with the crash of 1929. On October 29, 1929, Black Tuesday, the market plunged. And by mid-1932 the Dow had fallen about 89% from its pre-crash peak. What caused it? Speculation, margin buying, weak banking system, a cocktail of risk. The result, the crash triggered the Great Depression, lasting years. Fast forward to October 19, 1987, Black Monday. The U.S. stock market dropped about 22.6% in a single day. Causes included program trading, illiquidity, and panic. Unlike 1929, the crash was quick and the recovery faster. But the shock was real. Most recently, early 2020. The global markets fell sharply as the pandemic spread. Researchers found that this crash had bubble-like behavior underlying it. The drop was severe, but many markets recovered relatively quickly. What does it show? External shock can trigger a crash, but underlying vulnerabilities matter too. So what common patterns do these crashes share? And what lessons should you take from them? Overvaluation. Long bull runs ended when stocks became very expensive relative to earnings. High leverage or debt. Investors or institutions borrowing heavily increases risk. Shock or trigger event. Whether it's a pandemic, a policy error, or program trading, something ignites panic. Liquidity and investor psychology. When too many try to exit at once, the market can crack. Today, many analysts point toward rising margin debt, stretched valuations, and geopolitical risk. Which means the question isn't if a crash might happen, it's when and how much. But here's the good news. You don't need a crash to be prepared. You just need to watch for 2 key signals. Signal number 1, surge in margin debt. When investors borrow big to buy stocks, it means there's less cushion if things go south. Signal number 2. Liquidity strain or sharp valuation disconnects. If stocks go up despite worsening fundamentals, the risk of a sharp correction rises. If you see these together, you might not see a crash tomorrow, but you'd want to question whether you're exposed. So, will the stock market crash? We don't know exactly when or how big. But history tells us the risk is real whenever valuations are high, leverage is heavy, and a trigger event hits. The smart move isn't panic. It's preparation. Review your portfolio, understand your risk, and keep your eyes on those signals. If you found this helpful, please give this video a thumbs up, share it with a friend who's investing, and hit subscribe for more market insight. Leave a comment below. Which signal worries you most, margin debt or stretched valuations? I'll be reading and replying. See you in the next video.